Hey everybody, it's your friend Adam. I'm here with PSA Sitch, and we're doing a clipped out video about the SVB controversy that everybody's talking about because I've been arguing with people on the internet. We talked a little bit before we began the stream, Sitch, and it seems like you don't really understand the SVB, which stands for Silicon Valley Bank. There was a bank in Silicon Valley that ended up going belly up. It collapsed, and everybody is up in arms about, who do we rescue in the Silicon Valley Bank situation. So tell me, Sitch, what you know about it, if anything.
There was a bank, a dirty, lefty Silicon Valley bank somewhere in Silicon Valley land, and they lost money. And maybe it's the government's fault. Maybe it's not the government's fault. And some people are arguing about whether they should bail out the customers or not.
Okay, so
That's all I know about it.
you don't know the actual working situation. So Silicon
I know
Valley
nothing.
Bank, banks
No, nothing.
take. You probably have your money in a bank. Some of you have your money in a bank. Me, I like to keep my money in the mattress where it's safe. So I don't use these banks.
Like a good
Banks
MMT,
are
or you keep your money in the mattress.
banks are for squares. Okay.
Yes.
So, but some people, they do risk everything. Actually, I buy gold and I put gold coins in my mat. Some people, they keep their money in a bank, and those people they call depositors, right? Well, there are also people who invest in banks. They buy stock in the bank as a company. Sometimes they buy bonds, which is another investment vehicle that the bank can offer. So when Silicon Valley Bank got deposits from people, depositors, who have cash and need cash to do payroll or whatever they're doing, they need it liquid. Silicon Valley had all of this cash, and banks don't like to just leave the cash in the accounts. They like to actually make money off it. So there are only three things that banks can do with cash. They can't go to the stock market and buy Apple stock or Tesla stock, okay? Because that would
Why
be
not?
risky. And they don't want, look, we don't want them losing depositors' money, right? So
Wait,
the
wait, wait,
three,
wait. When you say they can't, are you saying they don't, or that they legally can't?
they legally cannot. Yes. The banks are regulated. In order to start a bank, you have to get a bank charter from I'm not sure if it's from the Federal Reserve. I believe it is. So you get a bank charter from a government organization, institution that says you can only buy three things, or you can only do three things with investors or with depositors' money. And this is
Hmm.
a problem with Sam Bankman-Fried, and you realize he took depositors' money and started buying stocks and other cryptos, right?
Right,
Because he
right.
was
So,
basically running an unregulated bank, and he lost all the money.
right. So, okay. So, what are the three things?
You can buy treasury bonds. Are you
Hmm.
familiar with those government
We are
assets?
familiar.
Yes.
Yes. Yes.
You
That
can
is the
make
government debt. Yes.
you can make loans with the money,
Okay.
and you can buy some mortgage-backed securities. And
Of course. Of course.
I am under the impression the reason you can buy some mortgage-backed securities is because, remember, the government bought all those toxic assets and they have like a shitload of mortgage-backed securities to sell.
I thought they off. I mean, I'm pretty sure they offloaded all that stuff from 2008.
I'm not sure what's going on with the
Well, wait.
mortgage-backed security
They
thing,
must
but
have been able to buy them in 2008, right? Because that was the whole problem. The banks were buying and
well,
trading them.
in 2008, the mortgage-backed securities were the problem. So the Federal Reserve bought those mortgage-backed securities, set up a toxic asset fund, and ended up making money on the mortgage-backed securities
Right. Right.
because the
Right. Right.
problem
Right.
was the maturity issue. So it's kind of the same thing with the Silicon Valley Bank thing. So Silicon Valley Bank, someone heard that well, actually, so they bought government treasuries, okay? Which you would think is the safest of those three options, correct? Well,
Yes.
actually,
Well, it is the safest.
they
Yeah.
bought government treasuries and mortgage-backed securities. They had both,
Okay.
but they had a very long maturity date. I think 5 to 10 years. So
Hmm.
as soon as you lock yourself into a bond that you're making 1% on, and it doesn't mature for 10 years, as soon as interest rates go up to 2%, obviously that bond becomes worth less, right? Because I can go buy a brand new one for 2%.
Right.
Why am I going to buy your old stinky bond that locks the money up for 10 years and I only get 1%? That's ridiculous. So all of these bonds became underwater in the same way a mortgage would be underwater. And they, you know, which isn't really a problem as long as you wait till the bonds mature. But in a situation where somebody says, oh my God, this bank is going to go out of business, and everybody shows up and wants their money back at once, everyone shows up and wants their cash. So you got to liquidate the bonds, and you're liquidating the bonds at a loss, right? So that's exactly what happened in the Silicon
Okay, so
Valley situation.
so for all the dummies like myself, so basically what you're saying is before the interest rates spiked, this bank bought a bunch of treasury bonds that were at like 1% interest. Now they're at like what, 4% or something?
We're close to 6% or
6%, okay.
5%.
Right. So they basically invested a bunch of money that they couldn't get out of these treasury bonds
Right. Yes.
for 5-year periods.
Correct.
And then once the interest rates went up, all these people ran the bank and they're like, hey, we want to take our money out and we want to either invest it in CDs at higher interest rates or whatever they want to do with it. And the bank didn't have enough money on hand basically to liquidate, to pay all the people that deposited money there.
Right. A lot of money started going out. They had to liquidate the bonds at a loss. And once they had to liquidate those bonds at a loss, it spooked everybody else. And everybody else, it started like a classic bank run. But what I'm saying, like, and what we're arguing about online is everybody's account is insured up to $250,000. You know, if you have a savings account, it's got FDIC insurance. I'm sure you've seen the little signs at the bank and stuff back when they had banks. I mean, who's been to a bank, right? But your money up to $250,000 is insured, right? But if you're a company that's doing payroll at $2 million a year, or $2 million a month, that means you have $2 million in liquid assets, and you have to spread that over 8 bank accounts in order to be covered by FDIC insurance. I mean, that creates a whole hell of a lot of work. My argument is, why not just, as the FDIC, insure all, up to 100%? Because if they had 100% insurance, the bank run would have never happened, because these people wouldn't have been worried about losing their money above $250,000, right?
Well, I mean, people presumably still would have tried to pull their money out to invest in something different, right? Even if like the fear bank run wouldn't have happened.
Right, but I'm under the impression that they had enough money to cover the people pulling their money out because they wanted a higher interest rate. And wait a second here.
Okay.
That's not what was going on though in this situation. You kind of brought that in here. Well, you brought that in there, and I kind of didn't really think about it. I'm sure there's some of that going on.
Correct me.
Well, I'm sure there's some of that going on, but they're not. This is liquid money that they're using for their company. They can't just pull it out and put it in a CD, okay? They need it for working capital for companies. They're talking about this is for payroll and shit. And it's one of the reasons why everyone's like, just let them burn. Which, okay, you're going to let all these small businesses and startup businesses just go bankrupt because you want to. It just seems silly to me. So I think the only reason why people were pulling their money out was because they thought they weren't going to get their money back because of the FDIC insurance situation. And it's a catch-22, because if the FDIC insurance was the full amount of the bank deposits, the bank run wouldn't have happened. And not only that, the Biden administration has gone in and said, we're going to cover 100% of the bank deposits, because why should you be punished? Why should you lose all of your money because you picked the wrong bank? Now some depositor has to be able to read a balance sheet to understand that the bank they're not investing their money, they're just putting their money in to save, isn't going to go bankrupt. The bondholders and the stockholders all got wiped out, and they should, because they're the ones that are supposed to read the balance sheet and know what they're investing in. So you had, when we talked about this before the stream began, you had some pushback.
Well, okay, so you said you think that the government should basically have a unlimited insurance policy for depositors at banks.
Yes.
So right now it's limited to 250. So this creates a situation where if you as an individual or a business has over 250K, they have to just spread it out to as many banks as possible to have it all be insured, essentially.
Yeah, Dan Irish showed me a thing that one guy at one company has 50 accounts he manages. Like, what a waste of
Right.
time.
Right. And so, yeah. And so the question is, well, if people are basically getting the benefit of this because they're still it's also insured, but they're spreading it out. What is the point of creating this, what is
Stupid
the point of this
regulation.
system? Right.
And the
But,
regulation itself
right.
actually causes the bank runs.
Right. But then the question was that John asked before the stream started and that I asked as well is how, like, if the government did this and they said, okay, well, we'll have unlimited insurance on bank depositors. I mean, I feel like that would have some unintended consequences that we're not aware of yet. I don't think it would just be like,
Right.
well,
Well,
nothing,
we can't.
nothing bad would happen,
I mean,
right?
luckily, we can't make legislation based on your feelings, though.
Well, that's why I asked you before the stream. I said, is there a country that does this already
Why
that
wouldn't
we
they
could
have done
look
this
to?
already? What,
What's
like,
that?
potential drawbacks? Like, what can you think of a reason why they haven't already done this?
Well, the thing is, the government tells them what they can invest in. Like this is the thing. Everyone's like, well, won't they do more risky things? They already tell them they can't do risky things. They already say, listen, you can only buy these three instruments. You can only use these three instruments, right? I mean, yeah, sure, they could make risky loans, but risky loans aren't. I mean, they're not necessarily making risky loans, even with depositors' money. As soon as you write a loan for like $5 million, you can sell that loan to another company or take money, use it as an asset as collateral, and take money from the Federal Reserve, and the Federal Reserve will give you new money. So doing loans is where the risky stuff is. Why are we risking depositor money?
Um, yeah, but well, I don't know the answer to this because I don't know enough about this. I'm just wondering, is the only reason, like, I'm assuming, and I could be completely wrong, that the reason for the limitation on the account isn't just for some weird political nonsense reason, that
It
there's
is.
some logistical reason.
It's for a song and dance reason. I'll do. There's another thing too that people are complaining about because they're calling this a bailout and the taxpayers are going to have to pay for it, which is completely untrue, because the bondholders and the stockholders all got washed out. In the bankruptcy, the Federal Reserve can take possession of the bonds that have the long dated maturity, right? And when they come mature, the taxpayer can get the interest instead of it going to bank profits. Bank profits would actually add to the money supply because new money's created to pay interest on the bonds. If the bonds are at the Federal Reserve, new money is paid to the Federal Reserve, and the Federal Reserve takes like an allowance from the Treasury and gives all the money it makes back to the Treasury. So it goes back to the Treasury, to the taxpayer. So, I mean, there's absolutely no downside to making the depositors whole.
Yeah, in this situation, I'm wondering because I'm trying to look for arguments for and against, increasing the FDI limit to not to unlimited, and I can't find any because everything just explains what it is.
Yeah,
There's
but
nothing like I don't know what the argument for and against it is.
this is the thing that everyone is saying. The FDIC currently only has 9 trillion in assets because it takes those assets. The banks pay a fee to the FDIC to accumulate money to deal with situations like this. But what I am saying is, if the FDIC just said we will insure all bank deposits 100%, they wouldn't need the 9 trillion because there wouldn't be any more bank runs.
Well, okay, so you're saying well, there wouldn't be bank runs, right? So you're saying that essentially the FDIC, the reason that people do these runs on banks is because they don't have
Insurance
unlimited
coverage.
insurance, right?
Yeah.
And if they did, then there would be
no
they wouldn't do
reason
the bank
to.
runs, right? And that might be true with this situation that happened now with SVB, but that wouldn't be true necessarily with what happened in 2008, right? Because that wasn't caused by a bank run; it was caused by banks making really poor investment decisions.
Well, this, I mean, is technically a really poor investment decision. The 2008 situation, depositors didn't lose money in the 2008 situation. What do you mean?
Well, well, that's
true?
only, yeah, but I'm saying like it's only because the banks got bailed out and merged together, right?
Well, I don't know that depositors lost any money in the 2008 situation. So
Yeah, but they
the 2008
wouldn't.
situation was banks went under because they invested in mortgage-backed securities in the
Right, but
mortgage.
if you had an account in a bank that disappeared,
Did you
right?
not get your money back? I don't. I think
I would assume you wouldn't, right? Unless you got bailed by the government. If you had, I'm assuming saying you have more than the FDIC
250.
required
Yeah,
amount, right? Yeah.
I'm not sure that was a specific issue in the 2008 situation. I'd have to look into
Mhm.
it, but
And was that insurance, that level of insurance in place in 2008?
I think it was. Yeah, that's
I
part
thought it
of
was
the
a hundred
problem
thousand
too.
back then, but I'm not sure.
Oh, okay, maybe.
It might have been less, but
So that's about all I want to say about SBC. SVB. SBC is, oh
S
man.
SCB.
SVB, Silicon Valley Bank. So
Yeah.
obviously, leave us your thoughts in the comments below. You want to say anything before I stop the video?
Well, I don't know. I feel like I want to know more.
Mm-hmm.
I want to know what is the argument against removing the cap. That's what I want to know.
Mm-hmm.
Because
You're
people just say, well, if you remove the cap, banks will just be more risky, right?
yeah, and
Is that the only
my
argument?
yeah,
Is
my
that the only
question
argument?
is, well, my question is how they don't want to go out of business. More risky how?
Well, I
They
guess people say,
can't
well,
they can't go out and buy Apple stock. And not only that, SVB bought the safest of the three investment options that they had.
right, but that just
They
shows
didn't know
right, but
the interest rates were going to go up.
right,
If
but that shows that it's just not just if you're managing all these people's money, it's not just a question of buying safe investments. You have to, account for possibilities of interest rates going up and all these different things.
no, yeah, no, they they messed up. They deserve their shareholders, the people who own the bank, and the bondholders, the people who own the bank, deserve to be wiped out. But the depositors, that's like ridiculous to me that you're going to wipe out people who just made the
Right.
mistake of putting their money in the wrong bank. That seems
So,
completely
right.
wrong to me.
So Lord Tenson's pipe says, why should a business like this not be permitted to suffer the consequences of its actions? So Adam is saying that the business would fail still, just the people that have their money in the bank, like when they just go to the bank, those people would be secure, but the business would still fail.
Look, if you're on a cruise ship, okay, and the cruise ship goes down, there are a lot of innocent people who die in that situation who got involved with the cruise ship, right? It's kind of the same thing. If like you're basically saying, well, these innocent people should just have to go down with the ship. It's like, no. Why don't if we have the power to save those innocent people, why don't we save them?
Yeah, but here's the question. If there was unlimited FDIC insurance, wouldn't it allow the banks to be riskier with who they loan money out to and how many mortgage-backed securities they buy?
Yeah, that's what I would think.
First of all, when you're loaning money, you're giving money to some third party. They're not giving you money to buy mortgage-backed securities. Depositors are giving you money, and you're using that money to buy securities and make an interest rate on the side. So the loan thing, making risky loans is a problem, but it doesn't really, we're not in a situation where people are taking depositor money and making loans. Like usually that's like a separate thing.
Okay.
Yeah.
PC for $20 says FDIC charges banks for the 250K coverage. These fees will go up these fees would go up with unlimited coverage. Additionally, why should banks pay an interest to depositors if there's no risk related to deposits? Also, increased regulation.
Yeah, well, I think the political move here is to, deregulate the FDIC. it's just odd to me that the party of deregulation, the Republicans, are the ones that are saying, no, these people have to sink. These people have to pay the price for walking into the wrong bank and setting up an account.
Well, okay. So regarding the question, I guess, I don't know how much does the FDIC charge banks for insurance? How much would it go up if it was unlimited? What would be that actual amount? Would it be,
Well,
an
first of
insurmountable
all,
amount?
here's the way it would work. If it went up to unlimited,
Right.
and they kept the charges the same, and we went, 20 years without having another bank run ever, wouldn't it mean that the whole thing was kind of a dog and pony show, and that?
Well, no, because I mean, I don't know what the history of bank runs in this country. I don't know if they happen on every 20 years, right? They happen kind of randomly, sporadically. Like everything's fine until it's not,
Right. But
And so,
but the FDIC insurance was introduced to stop bank runs.
yes, because of the Great
The
Depression.
only reason this bank run happened was because you have a bunch of business people that are banking at the same place, and they all have payroll accounts that are
I
way
understand,
more than
right.
$250,000.
Right. No,
So
so
we're trying to get bank runs
get
to
that,
zero.
right.
Yeah.
I understand. Right.
If
I don't know.
If there is no bank runs at all, you literally don't need the insurance. If we invented a car that never got in any accidents, and accidents dropped to 0 a year, would you need auto insurance anymore?
Of course not. But
Yeah, it'd be silly.
well, okay. So we'll two things. First of all, to answer the other question in PC Super Chat, the reason banks would still pay interest even if there's no risk to debtors is because they're taking your money and they're doing stuff with it to make money for the bank. So obviously they have to pay you some amount of that. Otherwise, what would be the point of putting your money in the bank in the first place? So that's the first thing.
Wait a
I don't think
second.
it's related to
we
the
have had
risk
zero. We have had zero interest rate savings accounts for 10 years now. Nobody makes any interest on their savings account. Are you making interest on your savings account? You're not telling me, Sitch?
No, I'm not.
Okay, yeah, exactly. What I keep telling you, hey, Sitch, you
Well,
should
then,
like.
okay. Well, then it doesn't matter, I guess, at that point, right? But well, no, but it's the same. Like if you buy a CD from a bank, you're making interest from it,
Yeah, totally.
right?
But
Okay, but it's not.
the
So we're not just
reason
talking about
why
savings accounts, right?
the reason why the CDs are going up right now is because that the Federal Reserve is literally paying interest on.
No. I understand. Like I understand.
On
but
bank
the question,
reserves.
okay. The question was, why should banks pay any interest if there's no risk to depositors? CDs are protected by the FDIC amount. Okay, so it's not just a question of savings. So I'm saying that when you buy a CD or you put money in your savings account that makes 10 cents or whatever the heck it makes, it's not just a question of risk that you're getting money, because the bank's actually making money off of your money. So that was just to answer that question.
Hypothetically, yeah.
Okay. So, but to
There's reasons to put your money
Right.
in a bank beyond making interest.
Right.
Most people
So-
don't want to do it. They want to buy stocks or bonds or something with a better
Right,
interest rate,
right.
correct? Obviously. That's That's another reason why I'm like, a deposit account, a savings account should be the safest thing on the planet.
yes. Well, okay, but so I understand your argument, sort of, about there should be unlimited amount. I'm just saying, like, intuitively, that seems like it will cause a potential problem. That we could be wrong. Maybe it'll be totally fine. But I think you need a stronger argument than just, well, if we do it, there won't, like, I don't think there'll be a bank run after that. Because it's like, well, but what if there is? Like, you have to map out what that would look like.
To get past your gut intuition.
Yes.
Right.
Well,
I
it won't get
understand.
past most people's gut intuition.
People,
But it will for me.
Look, people
for
are
me.
deathly afraid of change. And this is also a politically weird situation because you have every single person on the internet who is like a fan of deregulation and defunding the FDIC, who, I mean, you should be in favor of deregulating the FDIC if this is just some needless regulation that's causing a drag on businesses because they have to manage 50 different bank accounts just to cover this one stupid regulation. You should be a fan of getting rid of that. But all of a sudden, since it's a bunch of California people that they hate and perceive as their political enemies. Now all of a
Right.
sudden they're like, oh, regulation is great. This regulation needs to stay in place forever. This shouldn't be changed at all. I love the FDIC. Like don't change a thing, Adam. So
Right.
that's why I'm interested in it, just for the irony of it. Look, you literally, I listened to a podcast with Dave Smith, and Dave Smith was talking about letting the depositors go down. I'm like, oh my
Well, but
God.
that makes sense with a libertarian perspective, doesn't it? Because he doesn't want
Not
there to be any
look,
insurance, right?
Look, the whole situation was caused because the Fed, and he probably is all for ending the Fed, right? Because
but
the
no, what I'm saying
Fed
is- wait,
raised
wait.
interest rates, and because the FDIC regulation is too low. So the whole thing was caused by government.
Yes, but exactly. But Dave is a very simple man, Adam. Okay, he has a very simple worldview here.
Right.
So
Government is bad,
I'm
and we
assuming
should
his
get rid of it.
position. I'm assuming his position is that he doesn't think there should be any FDIC insurance at all for anybody.
Yeah, but this is your opportunity to get that. Look, the whole argument I laid out leads in that direction.
You're saying it should be unlimited, and then by making it unlimited, you predict that no one will need it. So there will be, technically it won't exist because no one will need it. But I don't know if that's true.
But down as soon as we come to the realization that nobody needs it, we can't get rid of it.
Okay.
Look, he literally is advocating to end the Fed. This literally was caused by the Federal Reserve.
I understand that. But I don't think your argument is going to be persuasive to a libertarian.
Every time we come up with some government regulation, every time we talk about some government regulation, they always spin it around on how that regulation was actually what caused the problem. This is the first time when I'm going, well, this is clear as day that it caused the problem, and they're not doing that. They're not doing the old 1-2, oh, the government caused this. They're not doing that. Why are they not doing that? Why?
Because ESG caused the problem. What are you talking about?
Yeah, they're pointing to all these other things when it's like so simple.
Well,
I mean,
usually when people because when you say oh, the government raised interest rates, that's not like a thing that people fixate on as a malicious action by the government. I think that's
not in your circles.
Okay. To the average person. I know in the financial world, I know everyone gets very
in investment circles, and anyone buying a car, and any first time home buyer, they understand.
I understand.
Yeah. So, okay. John, you want to say anything before we wrap up?
Ask one question, because I don't understand enough about this stuff to feel like I really have much to add in this conversation.
Me too.
But am I understanding right? Would this be a logically consistent position to hold if someone were to say, okay, I am for, in this case, bailing out the depositors of this bank under the condition that from now on, those regulations that we have through the you guys have through the FDIC are removed, and banks can kind of do whatever they want, so that the restrictions placed upon banks by the government are no longer in place, and therefore, if I'm understanding right, conditions that brought about the fall of SVB would no longer be a fault of the government. Would that be logically consistent if I explained that right?
No, because you couldn't get rid of the regulations, because then they would make the risky loans essentially.
Right. Yeah. We're trying to eliminate the risk as much as possible.
What Adam's position is, he's saying that so SVB got into trouble because they invested in the safest asset, which was treasury bonds, but then the interest rate went up, and so that led to, and there was some other, obviously more complicated than that, and people wanted to pull money out of the bank or something, and that caused some, or they said that they were going to lose a bunch of money, I think, and that caused a bank run, right? You're saying that caused a bank run. So Adam is saying if they had unlimited insurance, it wouldn't have caused the bank run in the first place.
Look, if you give me $5 million to deposit in the bank, okay, and I turn around and I buy a treasury bill that matures in 10 years for $5 million, okay, and then you come back and you say, oh, well, I need that $5 million, I'm going to take it out of my account, because your account's supposed to be cash, right? It's liquid money. Yes. That's what these savings accounts are.
Yeah.
I am going to have to turn around. I either have the money elsewhere, right, from other investments,
or you have to sell the bond. I understand.
Or I have to sell the bond, right? And if I sell the bond, that matures in 10 years, today I'm going to sell it at a giant loss.
So when I
Right?
say
But if the government, if like the government steps in and says, listen, SBC, you fucked up. Your charter's dead. Your stockholders are wiped out. The bond still exists. The Federal Reserve can take that bond, stick it in their bank account, and when it matures in 10 years and the interest is earned, they can give that money to the taxpayer. There's no reason not. Look, in the real world, the depositor's $5 million is in cash anyway. There's no reason for the Federal Reserve not to just give the cash to the bondholder or to the depositor.
Okay, that makes sense to me. I guess what I meant is, if I'm understanding right, part of your argument is that because the banks can only trade in 3 types of assets, that's a restriction put on them by, is that the FDIC or is that just part of
The government.
I think it's
That's
the
part of the
government charter, yeah.
right? So
Yes.
I guess when I said the removal of the restrictions, that's what I meant, is the restrictions upon what kind of assets banks can participate
I'm
in.
not advocating for getting rid of that, no.
Would that
And
be a logically
I don't-
consistent position to say,
well, I
let's
don't-
phase out the depositors this time, but then let's get rid of that restriction about what kind of assets they can trade?
I
Because
don't know. First of all, I don't know what you mean by logically consistent, because I mean we're trying to devise a regulatory scheme that's going to end up in not, people taking undue risk with other people's money. That's the whole point of it. So I do think, like, the whole point is, I mean, they could just leave it in cash. The reason why they're buying the Treasury bill is to make money on the side, right, at an interest rate. They could just leave it in cash reserves. That's what bank reserves are. They're cash.
Okay. Let me read something real quick. You can cut all this out if you want to.
No. I'm not cutting it out. I'm ending the video here then. Let's
Well, this is about
the
the situation.
Well, I don't want to look, we're going into like 30 minutes. Go ahead.
I
read your
understand
thing.
that, but I feel like we haven't adequately explained what happened.
Go ahead.
Okay. So this is an article from TechCrunch about this. It says, to quickly revisit the whole mess, Silicon Valley Bank lost $1.8 billion in the sale of U.S. Treasuries and mortgage-backed securities that it had invested in, owing to rising interest rates. So essentially, what happened was they wanted money. They wanted to have cash to loan out to people, or I guess to
make
to
the depositors whole. Yes.
Right, to make the depositors whole. And so they sold $1.8 billion of U.S. Treasuries at a loss.
Right. And they probably sold them to like Goldman Sachs, who's going to hold on to those treasuries and make the profit instead of them going to the taxpayer.
Right. It owned bonds, for example, that are no longer attractive compared with more newly issued bonds, and took a financial hit on these. The bank was also contending with shrinking customer deposits, given that its customer base of largely startups has far less money right now to park at a financial institution. Because of its predicament, it decided to raise a bunch of money to safeguard its business. The plan was to sell $1.25 billion of its common stock to investors, $500 million in convertible preferred shares, and $500 million of its common stock in separate transaction to private equity firm General Atlantic. The apparent goal was to project that the bank was being conservative and raising this money to stabilize itself. However, it backfired, and who can be surprised given it issued its announcement about these plans on Wednesday, just as the crypto bank Silvergate was announcing it was winding down operations.
Yeah, I'm not buying that stock. That's ridiculous. Like, you're basically trying to get me as a private investor to come in and take care of the problem that you created. I'm not going to do that. That's stupid.
Right. So this seems like it was just a massive mismanagement from the bank.
I agree. The question, look, I don't begrudge that it was a mismanagement of the bank. I'm saying, listen, we don't.
Yeah, no, I understand. Yeah.
We don't cut off the depositors who did nothing wrong. The punishment doesn't fit the crime.
No, I'm just wondering if there was unlimited FDIC insurance, would it have changed the situation? Would the bank just have lost a bunch of money, but it wouldn't have had a full-blown panic, essentially? Is your suggestion?
Yes. The people wouldn't, when they got that news, they wouldn't go, oh my God, I'm going to lose. Like, you wouldn't have had the depositors. The depositors would know, okay, well, my money's safe. I mean, you might have had the bank run.
Well, that's the thing. I feel like you might still have it anyway. I'm not sure. I don't know the answer to that. And the question would be if this is why I think you just need to have a little bit better argument. If there would be a bank run, what would it look like? From the government perspective,
Right.
to
Yeah.
pay all that money out. So, I mean,
Well,
it's almost saying that it's not like the government just pays it because these, banks go into bankruptcy and they basically, liquidate assets till they make everyone whole, and it's this whole complicated process. So,
they definitely lost money because they sold the bonds at a loss already. So they locked in that loss that they would have to make back over time.
Right.
So,
okay.
Yeah. I don't it's tough to say because the thing that just put the bank under was the bank run.
Gotcha.
Yeah. I don't know. They might have still gone bankrupt. Well, the outcome would be exactly the same as it is because the government stepped in and said, we're going to make the depositors 100% whole. No one's going to lose any money anyway. So in essence,
that's true. That's a good point. Yeah.
The regulation is exactly the way. It's just not on paper this way. So
that's how it happens every time anyways.
Yeah, and that'll probably happen the next time. But if we get rid of this stupid regulation, then we don't have to deal with it, and you don't get the political grandstanding. But you probably won't get rid of the regulation because whatever president wants to go in and say, "Listen, I saved the day." All right, that's enough. Bye-bye.